Why does everyone look rich online? Scroll for 5 minutes and you'll notice something unsettling. Everyone seems to be upgrading: a better apartment, a newer car, a watch that costs more than your monthly rent. And the strange part, most of these people aren't celebrities. They're your age, your former classmates, your coworkers, people who started from the same place you did. It creates a quiet, uncomfortable question. How is everyone affording this? Because at the exact same time this lifestyle explosion is happening online, something else is happening offline. Credit card debt in the United States has reached record levels. So either America quietly became wealthier overnight, or we're witnessing something else, something that doesn't show up in photos. The modern economy made one thing incredibly easy: access. You don't need to own the BMW, you can lease it. You don't need to pay for the vacation up front, you can split it into installments. You don't need to buy luxury goods outright, you can finance them, rotate them, resell them. And once the photo is posted, none of that financial structure travels with it. Ownership and leverage look identical on a screen. That's the real shift. Credit no longer just expands purchasing power. It expands perceived status, and perceived status in a digital world has value. Now add social media to that equation. Platforms don't reward moderation, they reward attention, and attention gravitates toward aspiration. A normal apartment rarely trends. A high-rise with floor-to-ceiling windows does. A reliable sedan doesn't go viral. A supercar does, because they are clickable, and once they dominate your feed, they begin to feel normal. The psychological baseline moves. What used to look exceptional starts to feel average, and what used to feel average starts to feel insufficient. That subtle shift changes behavior. There's another layer most people miss. For creators and influencers, lifestyle isn't just expression, it's strategy. Brand deals scale with perceived influence. Perceived influence scales with aesthetic. Aesthetic often scales with visible luxury. So sometimes the lifestyle comes first, not as a reward, but as an investment. Rent the car, stage the apartment, book the resort, capture the content, monetize the reach. If the sponsorship revenue exceeds the cost of the flex, it becomes rational. And when enough people adopt that model, the feed fills with amplified lifestyles funded by projected future income. The audience sees wealth. The creator sees risk, but risk rarely photographs well. Now, zoom out even further. You are not comparing yourself to billionaires. You're comparing yourself to proximity. People who share your background, your education level, your hometown. Social media compresses economic distance. It removes context. It removes balance sheets. It removes trade-offs. You see the vacation. You don't see the credit utilization ratio. You see the watch. You don't see the interest charges. You see the new apartment. You don't see the thin savings buffer. Algorithms don't show medians. They show maximum engagement, which means you're constantly exposed to outliers. Outliers begin to feel like norms, and that perception creates pressure. Pressure influences spending. People upgrade slightly earlier than they should, stretch slightly further than planned, accept slightly higher monthly payments, not because they're irresponsible, because the environment reframes what normal looks like. When everyone appears ahead, standing still feels like falling behind, and credit offers a shortcut. It smooths the discomfort. It bridges the gap between income and identity. It allows the lifestyle to match the expectation temporarily. Meanwhile, the broader system aligns around this behavior. Credit card companies profit from revolving balances. Buy now, pay later firms profit from volume and repeat usage. Luxury resale platforms benefit from rapid status cycling. Rental services monetize temporary ownership. Social platforms monetize engagement fueled by comparison. None of these incentives require long-term financial stability. They require participation. The economy doesn't need universal wealth. It needs scalable aspiration. And scalable aspiration depends on accessible credit. This doesn't mean everyone online is drowning in debt. It means the environment makes leverage invisible. A leased car can look identical to a purchased one for years. A financed watch can look like wealth. A carefully staged rental can signal permanence. Optics move faster than assets. Image compounds faster than savings. And because the financial strain accumulates quietly, the illusion can persist for a long time. What we're witnessing isn't a sudden collapse. It's gradual tension. Household debt rising, minimum payments rising, savings buffers thinning. At the same time, visible luxury culture expands. Two trends moving in opposite directions. And in the middle of that tension is perception. Perception shapes identity. Identity shapes spending, spending shapes debt. It becomes a loop. So the next time you scroll and feel that subtle pressure, that quiet sense that everyone else is accelerating, pause. Ask yourself what you're actually seeing. Are you looking at durable wealth, or are you looking at temporary access amplified by an algorithm? Because in modern America, access can look like ownership, leverage can look like success, and image can travel much faster than income. The feed rarely shows the balance sheet, but the balance sheet always exists, and eventually it matters.